Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Pool Lock YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. First question is from Cameron, who asks, why are 401ks so good during the growing phase while you're working, but really not so great once you enter retirement? All right, Cameron, that is a great question, and it's a little bit philosophical. So you think about for whom 401ks exist. Think about why employers have them. And maybe smaller companies, it's because people really care about their employees. They want to see them save money pre-tax, maybe even give them some matching. Now, when you start going to larger companies, are they really that benevolent? Or is it, they're an internal reason? And the internal reason, of course, is they want to attract and retain good people. That's a tool that they need to attract and retain good people, good employees. So the question is, whom do you think they're trying to attract and retain? People, my age or older, or people younger? Right? The answer is obvious. They're trying to attract and retain younger people. So they create these plans to be attractive towards somebody that's in their 20s, 30s, maybe even 40s, but not so attractive to people that are in their 60s or late 50s. But it's even more than that. You see, if you retire at age 65 and you live to 95, you leave your money in that 401k, that company has to pay administrative costs on your account each and every single year for the next 30 years. They don't want to do that. They want you to retire, take your money, and get it out of there and roll it over. So I think it's intentional that the options they have inside the 401ks are designed for people in the accumulation years and not in the distribution years or the income years, because those are the people it's designed to attract. Now, when you get older, you're retiring. If they make it a little more difficult to take withdrawals or they don't have so many options that pay high income, maybe the options are more growth or capital appreciation based. It'll entice people to move their money out when they retire, and therefore it'll save those administration costs. Now, here's where it really impacts your income strategy. Most 401k plans are heavily weighted towards growth-oriented mutual funds, target date funds that automatically shift you into bond mutual funds as you age. But what they don't offer are the income-focused investment options that retirees really need. Things like dividend-focused equity funds, real estate investment trusts, maybe immediate annuities that can provide that steady monthly paycheck you're looking for in retirement. The limited menu of options is in most 401k plans simply wasn't designed with income generation as the primary objective. Now, when you roll that money into an IRA, suddenly you have access to thousands of investment options specifically designed for income. You can build a diversified income portfolio with dividend aristocrats, right? Bond ladders, covered call strategies, other income producing assets that just aren't available in your typical workplace plan. So again, I'm not a conspiracy theorist in any way, shape, or form, but I do think this is an intentional thing and why companies do this, right? So very good during those targeted kind of years when you're trying to grow, but not so good later on when your focus shifts from accumulation to generating reliable income. 401ks are great for people that are in their working years. There's not so many good benefits for folks once they're ready to retire and need to focus on income generation. That's a great question. As always, if you'd like to send in your question, you can do so by emailing that question to poollock@poollock.com. Let's get to our second question, and this is from Elaine. Now she says, tell me a little bit more about mutual funds. I've had mutual funds in my 401ks. I know that some financial advisors use them, so I don't really understand. What are the issues? Well, you are right. some financial advisors do use mutual funds. The problem, though, is when they use mutual funds, they're really not managing money. And I hate to be overly critical, but I believe that my industry, right, the financial services industry, has gotten to a point where we are taught to be lazy. We're taught that it's okay to charge a fee and do no work in exchange for that fee. And mutual funds are a great example. A lot of financial advisors will charge you 1% management fee and then put mutual funds inside the account. Well, what's the problem with that? Well, each mutual fund has a fund manager in there that gets paid to manage the account. And let's say the average fee inside of a mutual fund is between 3/4 and 1%. You're paying that embedded fee. Some of that goes to the manager to pay that manager for that management. Then your advisor is charging you an extra 1% fee. So it's almost as if the fund manager is doing all the work and the advisor gets to tag along for free. So unfortunately, our industry has gotten to the point where it's taught financial advisors that it's okay to be lazy and not do anything and to charge a fee. So I'm not surprised when you say a lot of advisors do use those, right? But to answer your question, what's wrong with those, right? What's wrong with the mutual funds? Well, stock funds inside IRAs, I don't have as much of a problem with if you're comparing stock funds to individual stocks. Yes, there's a second set of fees, and that's an issue. Growth rates can be pretty similar in most cases. The biggest issue, though, with stock mutual funds is that they don't pay a lot of income. So if you're going into retirement and you're looking for income, it's hard to find stock mutual funds that pay a high dividend yield. Now, individual stock portfolios, you can get that all day long, but not so much with stock mutual funds. So again, good for total return, not so good not so much for generating income for retirees. But here's what really concerns me about stock mutual funds when it comes to income generation. Most of those funds are focused on capital appreciation, not dividend income. Even the ones that do pay dividends often reinvest them automatically, which defeats the purpose if you need that money to live on each month, right? When you own individual dividend-paying stocks, you have that complete control over whether to reinvest those dividends or take them as cash flow. Now, that flexibility is crucial when you're trying to create a reliable income stream in retirement. But the worst thing, I believe, are the bond funds, because I find in all my 30 years in the industry that when people approaching retirement want bonds, they want bonds because they have two important insurances. Number one, they have a fixed income payment, a fixed interest payment for the life of the bond that retirees can use to live off of. Then, when the bond matures, they get their fixed face value back. So assuming the company doesn't go belly up along the way, or they're diversified enough to not worry about it, then they know exactly what they're going to get from this portfolio over the long run. Guess what? If you buy a bond mutual fund, both guarantees are off the table. You don't have a guaranteed income payment, nor do you have a guaranteed date at which they repay the principal. So bond funds are inherently a riskier way to invest in the bond market for those of you who are looking for income. Here's another income-focused issue with bond funds. The distributions can be wildly unpredictable. One month, you might get a decent payment. The next month, it could be cut in half, depending on interest rate movements and the fund manager's decisions. That's not the kind of predictable income stream you need when you're budgeting for retirement expenses. So those are two major reasons why mutual funds might have been great in the accumulation years, but not so great in the income years. And unfortunately, we don't have enough time, in this kind of question and a Q&A show to go on and on. If I can get started about why bond funds are not a great option for those in retirement. But again, if you're not in an IRA, right? So if you're in a regular taxable account, guess what? That's an even bigger issue, right? Tax inefficiencies of mutual funds in taxable accounts can really eat into your income, especially when fund managers are consistently buying and selling securities and passing those capital gains distributions on to you. Now, full disclosure and being fair and balanced, there's one place where mutual funds do have a great advantage, and that's for smaller accounts. So if somebody has less than, say, $250,000 all in, mutual funds give you a way to cost effectively diversify. Let's say you have $75,000, you're trying to build out a portfolio of individual securities. Well, you may not be able to buy enough securities to diversify, and you need to be diversified. So for smaller accounts, mutual funds can make sense. But for most people who are on the brink of retirement, my hope is they would have accumulated more than $250,000, in which case, for most individuals, 401ks may have been the best tool to get you to retirement, but aren't going to be the best tool to get you through retirement. Two great questions today. If you have a question that you would like to send in, have answered, email it. Email it to poollock@poollock.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. And I'll see you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.